Hi, and welcome to this week's Symax Fintech weekly report. Just an overview of what happened last week, what's happening this week, macro outlook, and some charts as well. First of all, our disclaimer. So, trading involves the risk of loss of capital, not suitable for everybody, but of course, hope it is for you. Now, many companies provide leverage, so just be aware you could lose substantially more than your initial investment. The views, opinions contained in this is just purely for educational purposes, try and help you set up for the week ahead. And it does not constitute investment advice, or we're not encouraging you to trade or invest at all. It's got to be your decision. Of course, you should carefully consider the risks, your financial situation, definitely your level of experience and risk appetite. And of course, you should only risk capital that you're prepared, but more importantly, that you can afford to lose. Any doubts whatsoever, please seek independent financial advice before risking your capital. Don't wait until after you've made some losses. Okay, so there was quite a lot that happened last week. Always like to look back first before we look forward. So ECB raised rates by 50 basis points, so they're back to zero, out of negative territory, which is good. You know, again, it was mixed. Some people only thought 25. It had to be 50, otherwise, for me, the euro would have gone through par with the dollar. And of course, we had that sort of new program that they're bringing in, this transmission protection instrument, TPI. All of it is really, it's like an anti-fragmentation. What that means is that if there's a run on someone's bonds within the block, that the ECB will come in and buy those bonds to try and control the yield, stop them from going up too high. There is a certain criteria to meet, and it is at the discretion of the ECB whether they do it. They don't have that obligation. So they've sort of left it a bit vague, a little bit flexible. And I think that's to stop people taking, or countries taking advantage of it, which they could do otherwise. Now, it does mean the end of forward guidance. So what's that? It means that transparency. I covered this actually during the week in my Finico webinar, that perhaps central banks were too transparent, and it stopped them from being able to backtrack or change policy or not go as aggressive or as fast as they'd previously said they would. So by sort of taking that step back and not saying what they're going to do next, it's benefit for them. Okay, it makes it a little bit more challenging for us as traders, but you know, that's part of the fun of trading, I guess. Now, it's going to be based on a case by case assessment at each meeting. So they will look at the data leading up to that meeting. You know, most of these central bank meetings actually last 2 days, just because the decision comes out on a specific day at a specific time. And of course, note that from the one that's just gone for the ECB, they changed their times as well, so make sure you're aware of that for next time. And therefore that means that they're just going to look at the data that comes out and then make a decision. They're going to look obviously mainly at inflation. Draghi resigned as the Italian Prime Minister. He couldn't keep the backing of the coalition, so there's going to be a new election. Biden's got COVID, and cases continue to increase again. Now, in my daily newsletter that I put out, I mentioned this week I've started to look a little bit more in detail at these cases again. You know, we're in the summer months and yet cases are increasing. So, you know, what is going to happen over winter? And of course, you know, is it going to mutate again? And is this mutate going to remain around the Omicron Or is it going to go back to the delta? Is it going to create a new one? These are all things that, we've got to start being aware of, especially if we're taking those longer term positions. Japan left things unchanged. They will actually put more stimulation into the system if they feel that it needs it. And today there was, Sunday, there was a volcano erupting as well. So again, just bear in mind if you are trading Japanese yen. Now, Russia-Ukraine, obviously still ongoing, although we don't seem to hear so much about it at the moment, actually. Now, they have agreed to allow the exports of grains. Turkey sort of put this together. However, that said, they made the agreement, and then what happened? Russia shelled one of the ports where a lot of the grains would have come from. So we'll have to wait and see whether that gets honoured, and that does happen. I mean, it will be good for the shortage of grains if that is allowed to go ahead, because they've got millions of tons in storage. And Russia this week turned the taps back on, and the gas started flowing back into Europe through the Nord Stream 1. It's running at about 40%. Now, this is important for the European zone to reduce demand now so that they can build up that storage for the winter, because it's too easy for Russia to turn on and off the tap as they feel like it. Tech's dropped, so the tech stops, and part of that was because Snap came out, and that was much worse than expected. So their stocks dropped 39%. Twitter's results were disappointing. So overall, the tech stocks dropped about 130 billion. That's pretty much the social media element of it anyway. Crypto sort of had that little bit of a rally, and it got back to the 1 trillion market cap again, which is great to see. Bitcoin touched 24,000, but then it dropped again after Tesla announced that it sold about 75% of its holdings in Bitcoin. And ETH has been rallying just because there's a lot of things going on with ETH at the moment, so that's strengthened up, which again has helped with that valuation of the market cap. And German PMI came out below 50, which is negative. 50 or above is fine. It's not disastrous, but below 50 just means that people are less confident about what's going on with the economy. Okay, so looking forward to this next week. Earnings wise, we've got lots of earnings out this week. So just keep an eye on them. Some of the big companies are starting to provide details there. And then in the US for data, obviously the key is the FOMC this week. Everyone's pretty much pricing in and expecting 75 basis point increase. And then it's just going to be just listen to what's being said about that. Listen to what they're talking about afterwards. Are they going to stick to these projections? So is it going to be another 50 in another quarter before the end of the year? Are they going to start to take a little bit more of a wait and see approach? We'll have to wait till Wednesday evening to find that out. And then other data wise, we're going to see consumer confidence, new home sales, durable goods. So what are durable goods? If you don't know, then that means that the sort of goods that have a lifetime of a minimum of 3 years, so your electrical goods in your kitchen, those types of things, and obviously lots more, but that's durable goods. Then we've got GDP. GDP is just like going for that full health check, except this one's on the economy, includes pretty much every bit of data that comes out. PMI, so what's going on with the purchasing managers? Are they holding inventory? Are they reducing inventory because, again, if they don't want to be left holding a lot of stock if the economy does really turn. Then we've got personal income, production, expenditure. And of course, that's sort of a bit more about the consumer, so that's worth looking at as well. And jobless claims, because jobless claims again last week increased slightly. Now, for me, doubts about the economy going forward, how aggressive the central banks are being putting their rates up and all that. I can see these jobless claims continue to increase a little, not dramatically, but to keep going up for the moment. And I think, where all these jobs are available, where it got to there was 2 jobs available for everyone unemployed in the US, I think you're going to see that start to shrink. I really do. I think that's peaked. I think companies are going to rethink about how many staff they're actually going to take on, and they're going to drop those numbers down. In the UK, we don't have too much out this week, actually. We've got retail sales, basically, and housing prices. And then, of course, the big focus in the UK at the moment is the contest to who's going to be the new Prime Minister between Sunak and Truss. For the EU, again, some data coming out, inflationary data at that, GDP, we've got CPI, consumer confidence. I like consumer confidence. We account for about 70% of an economy. So if we're not confident, then we spend less. If we spend less, that's going to make the economy contract. And then we've got German IFO, German consumer sentiment, their CPI preliminary, and GDP as well. And that's sort of, obviously there's other bits and pieces, but they're the key ones that I'm going to be looking at this week. So macro outlook, I love to look at the fundamentals. It's the fundamentals that drive and determine trends. I love technical analysis as well, but technical analysis just helps with the timing of those entries, those exits, where to place your stops, etc. So the macro outlook, inflation, yes, still high. Although I really, really believe we're starting to see the tops there. In the UK, not necessarily. We may have that one last step to go into double digits. And the reason for that is because of the electricity price cap changing again. I think it's around October. So US 9.1, which was a surprise. UK's 9.4, which is an even bigger surprise. The EU's at 8.6. Food is at 8.9% though. We've still got the potential with the shrinkflation, less goods for the same price. Stagflation, just where you're getting inflation but without any of the benefits. And the potential for recessions, whether that's going to be later the end of this year or sometime next year. And that really is going to depend on how aggressive these central banks remain with these rate increases. Supply chain issues are starting to ease slightly. And, obviously, hopefully China's going to come out of their lockdowns. But that said, if cases are increasing again, are they going to be able to? Because they have this sort of like zero tolerance for them. We'll have to wait and see. It's going to make an interesting leading up to winter anyway. And then Russia, obviously, the invasion of Ukraine is still going on. The fact that Ukraine has applied for EU membership now, if Putin really wants to take over the whole country, he's probably going to speed that process up and become more aggressive, unless he's trying to do it in a different way, because it depends if Ukraine's fast-tracked into the EU or not. But if Ukraine becomes part of the EU wider war still going on, then that is really going to complicate things. Energy and food inflation, yes, it's still there. Now, raw material prices are becoming a little bit lower. I mean, metals have come off. They're pretty much back to where they were at the beginning of the year. Oil's dropped down as well. It's about $95 at the moment. Gas is lower because they've started the Russian pipeline again. Grains are lower, especially with the expectations that some of the exports are going to come out of Russia and Ukraine. But even before that, grains had started to come off a bit anyway. And then on top of that, we've got the pound against the dollar about 120. The euro had a little bit of a spike after ECB, but then dropped back again. So that's about 102.50-ish on Friday. And Bitcoin. So Bitcoin was doing nicely until the Tesla announcement was made. And then it dropped down, but it's still holding quite well. It's still above 20,000. It was over 22,500, in fact. So I think that's okay for the moment. But just remember, it's got that loose correlation to what stocks are doing, and stocks had a reasonable week, so that sort of helped to sort of boost and hold crypto up that little bit higher. Now, we're still seeing that lack of workers, although, I think that there's going to be more people keener to get back to work. I think there's going to be less people changing their jobs soon. They're going to be more trying to hold on to their jobs if things continue to look a little bit more sort of precarious and will start to go into a recession, because obviously we won't know if it's going to be a mild, soft recession or whether it's going to be an aggressive, hard one again. It's always difficult to gauge them at the moment. But, as I said before, just keep an eye on those jobless claims increasing. And I do expect the amount of jobs on offer to drop. Some countries are heading for recession. Timing is going to be everything there for these central banks. US public pensions, they've had the deepest drop since the Great Recession this year. Obviously, the stock market's down 20% or so. Government bond yields are dropping. That's investors potentially expecting inflation to have topped out, and also maybe that they expect the central banks to slow down their rate increases once they get these early ones out of the way. And the UK has announced it's going to regulate stable coins in their financial services bill. And while we're on the UK, consumer confidence remains at an all-time low. What a surprise.